chart is pretty clear, and I learned something a while ago from Todd Mitchell. I don't know if you've heard him. If you've not checked my blog, search for him, Todd Mitchell. You'll see a video from him. Watch that video. It's really interesting. Okay, in the chart he was using, there was virtually no indicators on the chart. But I wanted to make it simple for myself that when I see A, I do B. When I see C, I do A. So this is what is happening here on this chart. This is a 1 hour chart, and what I've seen from back testing the system, I've seen that most of the time when you enter a trade, it actually usually moves about 100 pips and above, about 120, 130. So that's how I've been working, and that's how I'm going to show you. As you can see, it's there keeping your chart clean. Only 3 indicators: the 200 moving average. It can be any one, whether just choose any one, but make sure that you're using the same with the 200, and the 13 moving average is this one, and the parabolic chart. That is all you need on this chart. So what happened is I usually look at the chart and see what is happening here. From what I learned from Todd regarding trend following, it's so interesting, and I see it so in the chart. So the chart is like telling me something right now when I see this happening. It's pretty exciting. So I'm showing you this. Okay, look at what happened here. The price candle for this hour closed below the 200 moving average. Now, if I was sitting on my machine at this point in time, I would go short immediately and put my stop loss 100 pips away, because the parabolic SAR is far above the 100 points that I can take as a loss. So that's what I do. But most of the time, when the trade starts to move normally, the parabolic SARs you will see when you're trading setup occurs, it's usually below that 100 point loss that you can take. But anytime it occurs like this, where the parabolic SAR is really far away, what you do, you just put your stop loss 100 pips away from your entry, and this trade still would have worked pretty well. It would not have even gone towards your stop loss, your initial stop loss there at 100 points. So you see that this trade would have gone pretty well in your favor. And usually I'll target 100 pips under for the 100 for the 1 hour chart. I'll usually target 100 pips. This works the same. You can set this thing up on any time frame and just follow the setup. And in this case, you can see the price came back up, hit the parabolic SAR, and this counter trend. So if you want to trade the counter trend, it's the same thing. Once price closes above the 13 moving average and hits the parabolic SAR, in my chart you can see when it's red, then you can only sell. When it's blue, when parabolic SAR is blue, then you can only buy. So because price is below the 200, here what I'm doing is keeping if I don't want to counter trade, what happens is I'll usually ignore trades like this and just wait for another down, for another sell setup. Now you can see here price closed below the 200, below the 13 moving average here, but I would not have taken that trade. Why? Because parabolic SAR is still below, so I wouldn't have a place to put my stop, or I would just go ahead and place my stop at 100 pips. But I don't want to do that once the trade has started falling down and things happening. So what happened is I waited about 4 hours later. 3 hours later, the 4th hour, there was an entry. This candle here created an entry because it hit the parabolic SAR, but that condition had already been met, that price closes below the 13 moving average. So what is happening here is that now at this candle would have taken the trade at 1.0169, and your stop loss would have come 1 pip above that parabolic SAR. That's 1.0232. That's about 70 pips. It doesn't reach the 100 that usually is acceptable. So that was a good trade there. And look at what happened after that. 1, 2, 3, 4, 5, 6. Target 100 pips away. 167. So you're targeting 10067. Did we get there? Yes, we got to 16077. About 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. About 12 hours of 13 hours later, your profit target was hit. So hey, you were not even sitting there watching that trade unfold. You're taking your trade, put your stop loss, put your target, and off, put the machine off and you are gone. So that's pretty good trade. Instead of sitting there and the emotions of the ups and downs of the trade beating you and giving you heartache, you can't be disciplined to do that. So, and look at the counter trade. If I take the counter trade, usually, like you see at this point here, and actually taking the counter trade because of what I saw happening on my 3-hour chart. I see a reversal is happening on my 3-hour chart. I feel I'm trade. Reversals are happening on this thing. That's the reason why I went ahead and took the counter trade here on the 1-hour chart. So I'm actually targeting the I'm looking for to come probably towards the 200 moving average. You see, it's the target is pretty close, so the trend if you're gonna go above that 200 moving average. Because of what I showed you in the 13 moving up in the 3-hour chart, I'll put it to 100 as a target. But it's okay, it's fine. It's okay. You can get there. Okay. So that's great setup. So if price is below the 200 moving average, you're looking to sell. If price is above the 200 moving average, you are looking to buy. But you can also counter trend trade if you have, because it usually takes a couple of hours for the trend to be complete. How to complete? Look at here. This one was moving up for hours, and this candle on the 13th of December at 4 o'clock European time. That's just about 1 hour after New York opens. Creates that entry there. Perfect time to enter that trade. And the result you see creates that's momentum. It's showing you the momentum of volume. It's high. So I just took the trade and put my stop loss and my tax. That's what I do. Do that away from your machine. A couple of hours later, 1, 2, 3, 4, 5 hours later, you were already in profit. You took the trade here at 1.0080 and target was 99.80. We didn't quite get there. Let's see, the low here was 81, so we didn't quite, just 1 pip to get to. It was 99 pips. So hey, you can use your discretion. If you're sitting on a machine, you can close it at that point, or you can still wait, hold on to the really closes above the 13 moving average. What you want to do is to close the trade. Close the trade and then you wait. But just a course later, you see there's a reversal. Tell the parabolic side. When I see something like this, at this point in time, I'll increase my lot size because what it's happening. You said the parabolic side is just one dot. The change occurs. When that happens, I am going in for the trade because I know that it did not even have the capacity, the volume, the volume, the ability to even move up for hours before making that, and I just did. So I can watch that the size is high on mine. So I was gonna go short at that candle here, but maybe big time, and just before you see that, you see 4 hours later, down almost every 4 hours later. So I try to close the trade there. And here you can see a counter trade happening. You see it produces that high there and started coming down again. So usually what happens when it goes up counter trend, it creates a lower high, it comes down and creates a new low. Here also a lower high comes down, gets a new low. Here a lower high, but this low was not a new low, and then price return. So if you get not a market or some other indication there, maybe RSI, you might be seeing versions of here. This is good to know that I think the strength of the trend is changing. I couldn't create a new low, but actually now it's taking out that high. So that gives you an indication from Todd's teaching on trend trading. It gives you an indication that the downward end on this hour chart is pretty over for now. So, but it's not the 200 you do. Now comes in your counter trend strategy. Right, you're going to have to this one. I don't know what happened. This might easily turn against this trade. But hey, the stop loss is there to protect me. That's the reason why initial stop losses are there. Now I'm not on this machine. So what I can do also is to change this stop and give it a trailing stop. So when I'm out of the machine, when it moves in my favor, I can block it on profits as it moves along. So that's the counter trade. And so this software is from FXCM markets hope 201. It's pretty simple and clear. So I hope that this helps you. Again, let me recap. Two moving averages, parabolic price below below 200. You are looking to go short. You can see that in this counter trend. You wait, patient wait. You have a setup here. Price is below 13 moving average and it has hit the parabolic star. Always try to take the trade at the moment that hits parabolic star, because from there it starts to move. So your stop loss would have come 1 pip above the value. I came in the middle of the trade. I'm gonna take this, and if it's less than 100, I'm gonna take wherever I am in this trade. I'm gonna calculate from here that entry there and see how far it has gone down. If it's at 100, then I don't mind taking the trade. But if it's below about 20, 30 or so, I can still take trade, knowing that there's potential to move about 50 more pips before it begins to change direction. So I want to hear. But you see that is here. You see A, you do B. You see this, you enter the real stop loss there. Get away from the machine and avoid emotions that come with day-to-day trade. If you don't have patience, please ask it from your Creator. God made you. He knows you. He knows who you are. And trading is such a good profession. Why? Because you have to learn things that you never knew about yourself. So I hope that this video helped out. But please leave a message. Leave a message on my blog and let me know what you think about this thing. Okay? God bless you.
Hi, this is Kirk with Forex Strategy Secrets. Just want to share with you a little strategy. This is a short-term strategy that we use. Now you notice that I've marked some vertical lines here. Now this is in history because the market is closed at the time that I'm making this recording. But you can tell when this indicator turned blue right here that was a change from red to blue. So we start looking at that. So this is on a 1-hour chart. Now I'm going to go to a 15-minute chart. That's what you're really wanting to trade, is the 15 and the 5-minute here. But we're trading in the direction of a trend of a larger time frame. So we don't know how long that's going to last, but we know that any time that the market turns up, we want to buy, then that's what we're going to do on a shorter time frame to time our entry. Go to the 5-minute, excuse me, the 15-minute. And here's an alert. Now this alert started clear down here and just rolled up as that bar formed. But so you're taking buy signals. Total was about 25 pip move, so you could have taken out between, around 10, 15 pips for sure on that one before it came back on you. Now you're still looking for buy signals, so you don't worry about taking this short move here, but you start entering here, and there's a good 20 pip move on that. This is on going from 15. Now let's actually time our entry better by going to the 5-minute. So you could go from the 1 hour to the 15, but usually we're really looking for the 15 and the 5 is where we want to time our entries. So we have the I got a good 20 pip move if you went to the 5-minute, And you see you're taking the same two trades. This is almost 25 pips that you could have had on some pretty straightforward moves. Now let's go back to the 1 hour. That was during a time the market really wasn't moving all that great. Now let's even go to a time when it's even less movement right here. Now we're still on the 1 hour chart, and we're just looking at this little area right here. It only went up for a couple of hours and then started coming down and went sideways for a while. That's the 1 hour, so you're looking for the trend. The strategy is to then, once you know what the trend is, to go to the 15-minute. Okay, and here's another signal to get in. And we know these are short moves. That was only a 10 pip move, but that's all we're looking at in a sideways market like we're seeing up there. But here's what the 5-minute looks like. You're waiting. You don't trade just because the 1 hour changed. You wait until you get a signal on a smaller time frame. That was a 13 pip move. Now let's go back and look at the 1 hour again. You can see that that wasn't during the time that the market was moving much at all. But we know the overall trend is up, and so we kind of check that on a 1 hour. If the 1 hour is going in the right direction, then we take the trade. So hope that was a help to you. Find the trend on the larger time frame and go and time your entries on smaller time frames. We have alerts and signals to be able to show you how to do this.
Let's talk about channels for a minute. Here we've got an upward trend, and as we discussed previously, we can draw a support line which represents a diagonal which is kind of guiding the price, and the price keeps bouncing off it in its journey to the top. Now what we're going to do is we're going to take this diagonal and we're going to copy it, and we're going to put it above the price. So there it is. It's got the same angle as the first one, and it's sitting on one of the highs of the price. So once again, as you can see here, the price is also bouncing off this diagonal as well, and bouncing downwards. The price is kind of moving in a channel or corridor. Now what are we anticipating from the price going forward? Well, right now we are probably expecting for the price to bounce off the top border and then to go back up. This is where we would enter into a buy order. So once the price has bounced off, we would wait for it to hit this bottom border of the channel. We would enter into a buy order, and if the price goes in our direction, once it hits the top border again, that's when we would close our trade. So it's important to note here that in an upward channel, it is recommended to trade only buy orders. And why is that? Well, let's take a few steps back for a second. At this stage, we're anticipating for the price to go down. So we could technically conduct a sell order, but it's not advisable for two reasons. First of all, we'd be trading against the trend, and that's something we said we shouldn't do. We should always trade with the trend. And second, as you can see here, the downward movement is actually smaller than the upward movement. So in an upward channel, if you create sell orders, you will always earn less than if you create buy orders. So that's another reason why in an upward channel you should only trade buy orders. Next, we're going to look at a downward channel. So here we've got a downward trend. We can draw a resistance line. If we copy that line, we can see that very often the price will also follow the copied line. So it won't break through it, will bounce off that line. And channels are very common on the Forex market, and you'll see this from our live trading on a real account further down in this course. So here we're expecting the price to go up, then we'll conduct a sell order, and we'll close our order once the price reaches the opposite side of the channel. So once again, in a downward channel, it is advised to open sell orders, because you would be, in this case, you'll be trading with the trend and you'll get longer movements. And so those are the two main ways of trading channels. It's actually one way, but in two different types of channels. And it's always trading inside the channel. And more often than not, the price does stay in the channel. But sooner or later, of course, the price will break the channel. And that's why there's an alternative strategy where, in this case, instead of opening a sell order, you would open a buy order. And you would expect the price to go somewhere out of the channel. You would use this strategy when your other analysis is telling you that this channel is getting too old and the price is going to break through it. So when a channel is quite new, there's more chances that the price will stay inside. When the channel has been around for a while, the chances of the price breaking out are constantly growing. Both strategies are valid. Depends on the situation and what your other technical analysis tells you. So to sum up with channels, direction, trade with the channel, stay inside the channel. It's more likely that the price will bounce into the channel. There's an alternative strategy, which is a breakthrough strategy, and that is used when you expect the price to break free from the channel.
Alright, so that was channels. Did you enjoy this tutorial? Well, if you did, then you might want to check out the full course. And the good news is that I've prepared an exclusive discount for those who have seen this preview. Just check out the link in the description of this video and you can get the full course with a massive discount. I look forward to seeing you in the course, and until then, happy trading.